Welcome to This Explainer. Listen, if you're a newer retail investor watching the crypto market right now, I know it probably feels like a completely chaotic storm. With Bitcoin recently taking a dive below $62,000, anxiety is, well, it's totally natural. But I want you to pull up a chair. As a financial advisor who's navigated these exact turbulent waters a time or two before, I'm here to tell you that we're going to find clarity together. We're going to filter out all that panic and zero in on the actual mechanics of long-term wealth building. So here's our exact roadmap for today. We'll cover surviving the market noise, why prices are actually dropping, whales versus retail investors, those long-term 2030 price forecasts, the million-dollar math, and finally, your personal dollar-cost averaging plan. All right, let's jump right into part one, surviving the market noise. Look, seeing the market drop 30% year to date, plus long-term holders unexpectedly selling off $2.4 billion in June, yeah, that is incredibly intimidating. But we have got to separate the short-term noise from the long-term value. On one hand, the noise is absolutely deafening, right? You've got traders who made risky leverage bets getting forcibly wiped out, and that creates this nasty cascade of selling. That's just the inherent risk of crypto derivatives. But on the other hand, the long-term value, it is completely intact. The fundamental supply of Bitcoin remains strictly fixed, and global institutional adoption hasn't slowed down one bit. Now, take a look at this number, 57.4. This is the BVIV volatility index, and it recently spiked to its highest reading since April because traders were just rushing to buy protective options. Honestly, think of this number like a weather vane, and right now it's pointing straight to peak fear in the market. Volatility is kind of like unpredictable daily weather. It can ruin your afternoon out of nowhere. But smart investing, that's about focusing on the predictable changing of the seasons. Fundamentally, the long-term seasons for digital assets are still pointing toward growth, and holding through this extreme fear builds the exact psychological resilience you're going to need to succeed. Moving on to part two, why prices are dropping. Let's demystify some of these scary headlines, because there are actual measurable mechanics behind this plunge. First up, massive amounts of money are temporarily shifting out of digital assets to fund the booming artificial intelligence sector and the upcoming SpaceX mega IPO. Second, we've got legislative delays. The Clarity Act, which was meant to establish market rules, is stalling out amid election year politics, and if there's one thing the market hates, it's uncertainty. Add in the first ever Bitcoin sale by massive corporate holder MicroStrategy, plus those massive leverage wipeouts we just talked about, and boom, you have a perfect storm. And the result of that perfect storm? A whopping $1.26 billion. That staggering figure represents the money that bled out of spot Bitcoin ETFs in just a single week in May. In fact, we saw 13 consecutive days of outflows. So if you're feeling afraid right now, this number completely validates why. When you see massive funds recording negative flows day after day, it is totally natural to feel like the smart move is just to run away. But let's take a deep breath for a second and look at this insight from Michael Saylor, the executive chair of MicroStrategy. He says capital markets are funding the AI build-out. This is capital rotation, not a Bitcoin impairment. The underlying utility of the asset hasn't broken at all. Capital is simply taking a temporary vacation to chase shiny new toys and emerging tech. Like he said, it's a rotation, not an abandonment. Panic selling right now, that just means giving up your seat right before the music starts again. This brings us to part three, whales versus retail investors. Now, this is where we need to follow the smart money. Check this out. While everyday retail investors were panic selling and fleeing ETFs for 13 straight days, the deep-pocketed institutional whales, well, they went on a massive shopping spree. In a 30-day stretch ending in April, whales quietly accumulated 270,000 Bitcoin. That is roughly $23 billion worth. It's actually the largest whale accumulation we've seen in over a decade. Why? Because they absolutely love maximum fear. It allows them to buy heavily discounted assets from panicking retail traders. And it's not just anonymous whales doing this. Huge corporate treasuries are locking up the global supply too. You have Wall Street giants like Goldman Sachs holding over $1 billion in Bitcoin ETFs and massive pension funds like CalPERS gaining exposure. Because these giant entities buy to hold, exchange reserves have actually hit a 7-year low. This matters immensely because it creates a powerful structural scarcity. Put simply, less supply on the market inevitably benefits the patient holder when that demand eventually returns. All right, part four, long-term 2030 price forecasts. Let's look up from the current storm for a minute. Standard Chartered is projecting a rise to $150,000 by 2026 and reaching $500,000 by 2030. Meanwhile, Bernstein forecasts a $200,000 peak in 2027 and an absolutely incredible $1 million per coin by 2033. Now, sure, these heavily depend on regulatory clarity, but big banks are anticipating massive institutional adoption, especially as clearer crypto regulations over in the European and Asian markets unlock whole new waves of corporate demand. These ambitious targets, they're crucial benchmarks for patient investors like us. To really build your psychological resilience, I want you to remember November 2022. The collapse of FTX caused maximum panic across the board, dropping the price all the way down to $15,500. Yet, by October 2025, the market peaked at $126,000. Think about that. That is an 8x return. History repeatedly proves that buying when the headlines are absolutely terrifying historically rewards patience. Actually, the window to accumulate during a crash is very often the single most profitable time in a market cycle. Moving to part 5, the million-dollar math. So, moving from abstract predictions to real, concrete numbers, how many coins do you actually need to hit $1 million? Well, if we hit the conservative estimate of $150,000, you'd need 6.7 coins. At a $250,000 price point, you need 4 coins. And if Standard Chartered is right about a $500,000 price by 2030, you only need 2 coins to hit that $1 million dream. Accumulating them really just requires discipline while the prices are low. Now, you might be wondering, why does this opportunity even exist right now? It all comes down to market cycles. See, we're currently in a transition phase where panic selling essentially exhausts itself. The sellers quite literally run out of coins to sell. When that severe lack of supply meets the massive, expanding demand of global pension funds preparing to enter the market, prices have nowhere to go but up. The window to accumulate before those funds fully arrive, it's rapidly closing. Finally, part 6, your dollar cost averaging plan. Here is your stress-free playbook for navigating any market dip. Step 1, ignore the short-term ETF flow noise. Seriously, stop checking the daily red and green candles. Step 2, buy steadily at these current discounted levels. Instead of trying to perfectly time the absolute bottom, which is almost impossible, use dollar cost averaging. Just buy a set dollar amount every week or every month, completely regardless of the price. Step 3, hold patiently toward those 2030 institutional forecasts we discussed. Act like a seasoned investor, not a reactive trader letting emotion dictate their finances. I want to leave you with this final, provocative thought. 10 years from now, will you remember this week's panic or the position you built? Please, don't let temporary market rotations shake you out of a solid long-term strategy. The smart money is quietly accumulating while the noise is at its absolute loudest. So, decide which side of the trade you want to be on.